If you're trying to buy a home right now, you know how tough it is. And making any one of these 5 mistakes could cost you your house. So here's what not to do. The first mistake is waiting on interest rates to drop, which 71% of aspiring homeowners are doing before buying a home. This means this is probably you. But here's why waiting could be a big mistake. When the bank gives you your loan for a new house, it comes with a specific interest rate. As of now, the rate would be around 6 to 7% for a 30-year fixed mortgage. For context, interest rates were about 3.5% right before the pandemic. But even if lower interest rates can save you money, here are 3 reasons why you might not want to wait. The first is that, sadly, the interest rate probably isn't falling anytime soon. According to Wells Fargo, interest rates for homes won't dip below 6.5% through all of 2025 and 2026. And even as the Fed has lowered interest rates, the mortgage rates have stayed pretty steady. Now, the second reason is that when interest rates come down, more buyers who have also been waiting are ready to make a move. This means there may be a ton of competition trying to buy your dream home, which sometimes leads to a bidding war and a higher total cost for the home. We'll talk about home prices in a bit, but we've seen this time and time again. Higher interest rates actually keep more buyers on the sidelines, and instead of paying more for the home, you could even negotiate the price down. I'm not just saying this. Let's look at what happened during COVID. As you know, in March of 2020, the world was beginning to feel the effects of the pandemic. In an attempt to not collapse the world economy, the central banks encouraged spending by reducing the interest rates. The problem was that because interest rates were so low, everyone who wanted to buy a home was in the market looking for a deal. This means demand for houses shot up, and everyone started trying to outbid everyone else so that they could lock in a low interest rate. I mean, if you know someone who is buying a home around 2020, you probably heard a story or two about how someone would come in with an offer that was tens of thousands of dollars over the asking price. And this also put buyers who were only paying a down payment at a disadvantage because wealthier buyers would come in and pay all cash. And the third reason is that the interest rates that you have when you buy your home kind of doesn't matter as much as you may think. You may have heard of the term date the rate, marry the house. It's kind of a crude way of saying that if you love the house and can see yourself living there for years to come, take the plunge and buy it, because you can refinance the loan later and get a better deal. Speaking of refinancing, I published a video on whether you should refi your car or not. Check it out after this one. And make sure you like and subscribe so you don't miss our next video on 6 things to do after getting approved for a personal loan. Now, this doesn't mean buying something way out of your budget, because you will need to be able to afford it for a few years before you have the option to refinance. But I'm just saying, don't put so much weight on that initial interest rate, as everything can be renegotiated down the line, assuming rates cool down. I should also mention that when you refinance, you typically have to pay closing costs again, which could be 2 to 6% of the home value. And this could be anywhere from a few thousand to tens of thousands of dollars. The next mistake is waiting for home prices to drop, because it's probably not going to happen for quite some time. And look, I get it. The median house price has been going up forever and currently sits at $419,000 in the US. It's gotten to the point where buying a home feels out of reach for most Americans, and with good reason. Instead of just telling you, let me show you. The average salary is around $60,000. And if we use the 30% rule, that tells us our monthly housing cost should be 30% of our monthly income. So if you have an average salary, the most you should pay is about $1,500 a month for a mortgage. But if we look at our monthly all-in cost for a median-priced home, it'll range between $3,000 and $3,500, depending on how much we use for a down payment. This means the average salary can't afford an average home. So it's only natural to think that when the average person can't afford a home, prices have to come down. But that's not how it works, unfortunately. Remember when I discussed interest rates and how it can be even harder to buy a home when they go down? Well, the competitive housing market during COVID and low interest rates caused the median house price to shoot up, where it stayed ever since. So if rates fall, be prepared for home prices to rise. But remember, unlike interest rates, you can't refinance the total value of your home even if the housing prices crash. The other reason why home prices won't fall as much as you probably want is because if you look at home prices over time, they've always gone up, regardless of how the economy and how the average person is doing financially. So if it's in your budget right now, go for it. Make a plan and get your home. Speaking of budget, that's one mistake you cannot afford to skip, which I'll get to in a bit. The next mistake is using the wrong loan, which could force you to pay too much for your down payment. Most new home buyers don't know this, but there are 3 main types of government-backed loans that you can get, and you don't have to use a conventional lender, which would be something like your local or national bank. Conventional loans could be great if you have good credit because you could score a lower interest rate. You also get a lot of flexibility when it comes to choosing your loan terms and refinancing later on, but they do usually require a larger down payment. And for the vast majority of first-time home buyers, this is probably going to be your best bet. But if you don't have a great credit score and don't have as much saved for a down payment, there are 3 government-backed loans that could be better for you. The first is an FHA loan. The biggest benefit of an FHA loan is that they require a much smaller down payment of 3.5%. This is much smaller than the standard 20% down payment. And they're also a lot more lenient on credit scores, with a minimum accepted score of 580. But you will have to pay monthly mortgage insurance until you've paid off 20% of the home. An FHA loan is a great choice if you're a first-time home buyer or on the right track now, but your financial past isn't as solid. The next is a USDA loan, and this one only really applies if you're living in a rural area. But a quick note that your income also can't exceed a certain amount with this one. But if you can get past all those restrictions, you can buy a house with 0% down payment, competitive interest rates, and no minimum credit score. The last government loan is a VA loan, which is only available to veterans, active duty service members, and military widows. Like USDA loans, you don't need a down payment and there's no minimum credit score. The right loan for you is going to depend entirely on your situation, so just make sure you look around for the one that suits you best. Another mistake that is all too common is new home buyers overestimate what they can afford and budgeting wrong altogether. And there are several parts to this. First, you need to take a look at your debt-to-income ratio and what factors into it. By the way, mortgage lenders look at your debt-to-income ratio when giving you a loan. To find your DTI, add up all your monthly debt payments like car loans, credit card payments, student loans, child support, or any other recurring obligations. Then, divide the total by your gross monthly income, aka how much you make before taxes, and multiply it by 100. If your debt-to-income ratio is above 43%, you probably won't get approved for a home. You also want to make sure you don't become house poor after buying property. Being house poor means that too much of your income is being swallowed up by your home expenses, leaving you with little flexibility to cover other life expenses like food and gas. And yeah, it's about as fun as it sounds, which is why you need to be so careful and precise when budgeting. But this next part is where people can really get into trouble. You need to make sure you're factoring in all of the other costs that come with buying a home. If you don't do this, you may get your home and end up not being able to afford your mortgage and go into foreclosure. And remember, closing costs are usually 2 to 6% of the home price and can come out to tens of thousands of dollars on top of the down payment. If you factor in all the other monthly costs like property taxes, homeowners insurance, HOA fees, pest control, and all the utility costs, that could add an extra $1,000 or more a month. And then there's the unexpected costs like emergency home repairs. See how it adds up? Not trying to scare you, but it's the truth. Before I get into the final costly mistake, emergency home repair is actually one of the biggest reasons why people get loans from CreditNinja. So if this happens, you should watch this video on how to get a same-day loan. CreditNinja personal loans are incredibly easy to manage and have over 275,000 happy customers and thousands of 5-star reviews on Trustpilot. The final mistake that homebuyers make all the time is waiving a home inspection, and this can cost you tens of thousands of dollars in unexpected repairs. And once again, I get it. When you really want a home, it's tempting to skip this step to get your offer in. But don't be tempted, because by not getting an inspection, you're essentially buying the home as is, accepting all visible and hidden issues. This could lead to a lot of unexpected expenses, from minor repairs to major structural fixes. You can just Google "didn't inspect home" and go on Reddit to see the true extent of the damages this can do. And it's an incredibly silly step to skip, because it costs nothing in the grand scheme of things. It's like $300 to $500 for an independent home inspector. $500 for true peace of mind sounds like a bargain to me. And if the market is so hot that you're considering waiving the inspection, chances are you're already offering above the asking price. So consider if you can even afford all the expenses we talked about earlier. Regardless, buying your first home is an incredibly exciting time, and we hope this video has calmed your nerves and helped you be more prepared. Make sure you subscribe so you don't miss our next video. Thanks for watching, and we'll see you on the next one.